I want to introduce you to Cole Weston. Cole is in charge of our endowment's real estate platform, so be very nice to him. We should take out an insurance policy on you, Cole, because the Yale Endowment has been really a wonderful thing for us. And the spirit of David Swenson and David's commitment to real estate lives on. It's been really a great thing for the industry generally and for the Yale Endowment. So Cole was at KKR, he was at Morgan Stanley, he's a Yale College graduate, and the new generation of leaders that is going to steward our endowment into the future, higher and more money and better and all of those things. So please join me in welcoming Cole, who's going to introduce the Pantzer brothers to us on the next panel. Thank you.
Thanks so much. Thank you.
All right, can everyone hear me? All right, good morning. Thank you, Kevin, for the introduction. My name is Cole Weston. I work at the Yale Investment Office and manage the real estate portfolio for the endowment. I have the pleasure of being joined on stage today by Jason and Jordan Pantzer, who are co-general partners of Pantzer Properties. And I've had the pleasure of doing them for almost 10 years now. Pantzer Properties is a premier institutional manager in the industry, and they focus on multifamily investing, and they're currently on their 6th fund. Jordan and Jason oversee the firm's investment, asset management, and fundraising decisions, and they each have over 30 years of experience in the real estate industry. In addition, they are involved with numerous charitable organizations, such as New York Weill Cornell Council and New York Presbyterian, and the Board of Advisors of Penn Live Arts at the University of Pennsylvania. In addition to being co-CEOs of Pantzer Properties, Jason and Jordan are brothers. So I'll start off with a question for Jason. What is it like working together as brothers? And how does that connection impact the culture of the organization and your philosophy around building a team?
Well, thank you, Cole, for having us. It's always nice to be here at Yale. I consider myself very lucky to be able to work with my brother. It's a dimension to the relationship that most people don't have, to work in business together. And to have been the architects of our real estate fund business, which is now you mentioned is on our 6th fund that we started together, is really something that we're quite proud of. I would say that if you're going to go into business together, it's not something you do kind of on the first step out of college. So I'm happy that Jordan and I both had about a decade of experience in Wall Street, the most formidable ones. We're working for real estate opportunity funds, Jordan at Starwood Capital in the 90s and myself at ING in the 90s, and that's when real estate funds were first starting to develop. So we really got a ground floor seat on that experience, which was extraordinary, and then brought that knowledge base towards our fund business. We thought there was an enormous disconnect between discretionary capital and management of the assets. We thought that if you could combine those two skill sets with discretionary capital with great property management, you'd have a very powerful combination. So bringing that experience into the business and then formulating the business together was something that we were very happy to be able to do. The second thing I would say is that we were able to establish ground rules early, and ground rules that you really want to stick by, and proper governance. So, for example, you don't broker each other. Nothing is my deal or his deal. Nothing was your bad decision or my bad decision. You're rowing the same boat, if you will. You discuss economics once, you never discuss them again. And finally, and I would say most importantly, you have to have a great time together. You have to laugh every day and enjoy how lucky we are to be able to do this together.
And just how have you been able to extend that philosophy to the rest of the team? And in terms of how you think about culture and hiring?
We're very thoughtful about hiring. We spend a lot of time with these people every day. We're an in-office business, 5 days a week. We want to make sure that the people around us are great thought leaders. We also want to make sure they're not yes people. They're not agreeing with everything we say. So we want people with great academic pedigree, great work experience. We want to develop a terrific culture within the firm. And we really like a flat organization. For example, in our deal meetings, everyone must speak, Everyone must vote, and must give their opinion. We don't like anyone kind of being siloed from a work experience where someone's only an acquisitions person or only an asset management person, or only focus on one geography or not the other. We like people to have rounded skill sets and be well-rounded in that regard. And so we think the culture is extremely important in an organization.
Great. So discretionary capital and exceptional property management, that's where you guys are today in your sixth fund. Jordan, can you, as you reflect on the journey to how you got to where you are today, can you please walk us through some of the pivotal moments in the institutional journey for Pantzer Properties?
Happily. First, thanks for having us. Delighted to be here. It's been an incredible journey. Nobody wants to be in your first fund. So really starting the fund business from what was a syndication business and an aggregation of capital into a discretionary pool of assets was a pivotal moment for us. And then proving that out as those funds had success and then kind of bringing in institutional capital, with Yale being the leader in that regard for us and an incredible supporter of ours and proponent of ours, and growing and cultivating that institutional capital was another pivotal moment. I would say also that we, due to our saturation in the marketplace and understanding of the micro markets within which we invest, really understanding where the opportunities and the risks are, have been born out of some of those pivotal moments. One was really seeing the opportunity to go from value add 1.0 to value add 2.0. So buying newer assets in better locations where there were strategic opportunities for operational execution beyond just kind of compressed cap rates in second-tier locations, second-tier markets, where certain risks that had not been obvious at acquisition, like non-revenue producing capital needs and other market risks or a lack of revenue opportunities, seeing those trends and really taking advantage of that and evolving into where we are today has been some pivotal moments for us.
That's great. And you just said two things there I want to kind of double click on. It's really, number one, the LP component of it and getting institutional capital. And the second is really, the edge or the new edge that you guys are kind of leading with. So I wanted to double click on both of those. So Jason, kind of on the first part, as an institutional manager, how do you think about crafting your LP base and why does it matter?
Well, it certainly matters. It's a partnership. I think many people view it as a transactional relationship. And I think if you view it as a transactional relationship, you're not going to have a successful partnership. You have to view it as a true partnership. It is a different dynamic. It's a different experience than, for example, a lender relationship, which is far more straightforward. The lender has a principal, you get their principal back, they get paid their interest. That is something that is easier to understand. But a partnership is something that you're living with for almost a decade in most funds. Ideally, it's a partnership that continues into multiple funds, so you have multiple experiences. And the pathway to success is often, not a linear one. So you need to have someone that you can talk to, someone that you can relate to as far as challenges that come up, and so someone understands that directionally you may be accurate, but at the micro moment, perhaps you have to have some reflection and some dialogue. I think partnership is built on trust. I think partnership is built on collaboration, and I think it needs to be an iterative process. So I really do emphasize that partnership is very much different than most forms of investment because you are with a person, although you may be called a limited partner, we very much value the relationship, we value the perspective, and we do use each other in terms of a dialogue base to go back and forth with data, which I think if it's not a two-way street, then it's an imbalanced partnership. So you want to make sure that from a data collection perspective, from a macro and a micro perspective, you're utilizing the resources, and partnership is the best resource you can utilize.
That's great. And kind of on the point of partnership, the industry's proliferated in terms of the amount of fund managers out there. What do you think are the biggest mistakes that GPs can make when it comes to threatening this idea of partnership with regards to their LP partners?
Well, if you view it as transactional, I think that's mistake number one. As far as mistakes I think GPs can make, I think there's probably there are a few. Certainly if they're dishonorable, do something that's improper, that's the quickest pathway to blowing up a partnership. I think that if you are raising capital that perhaps is too much for you, you effectively scale up too quickly and didn't invest in your infrastructure, in your team, in your systems, in your operations, perhaps you just do not have the ability to transact at that level. And when you have money burning a hole in your pocket, if you will, that you then need to go spend, that is a terrible incentive. You need to be sized up accordingly for the opportunities that exist. And I would say, finally, straying from your lane. If you're straying from your lane and trying to be effectively all things to all people and not doing what you said you were going to do, that's a terrible incentive. So we have often heard from managers that say, wow, I found a great office building, or I found a great development site. And we said, but you're a multi-manager on the East Coast. And they said, but it's a terrific deal. It may be a terrific deal. It's not a terrific deal for the confines for which you have brought in your partners and told them what you're going to do. So I think guardrails and focus, alignment are very important. And then lastly, I would also say, it's funny to me how often people say that they treat a partner's money like it's their own. And I say, well, how much of your own money is in the investment? And very little. I think you need to have conviction. You need to invest a substantive amount, which Jordan and I certainly have in our business, and that makes a successful aligned partnership.
That's great. That's great. And definitely a lot of things you're mentioning are definitely things that we track and pay attention to and have seen many GPs make mistakes regarding. So it's just really helpful, sound advice. Pivoting to the edge part of what you're talking to, Jordan, so kind of wanted to double click on that. Competing in the investment management business and delivering top returns across multiple funds is no easy feat. And it requires investors to find an edge and then transform that edge into a sustainable moat. You were kind of discussing this when we discussed your approach to value add 2.0. Can you just expand on that a little bit more and talk about how you created your moat as an investor and how you go about sustaining it?
Having an edge and a discernible one is critical, especially when you're a niche specialist and a geography specific. So we focus a lot on sourcing. We look to create transactions, even when transactions are hard to come by. So in disrupted markets like we've seen in the past 12, 18 months, there's been very little capital flowing. But yet we've still been able to be very active, having purchased thousands of units over the past 12 to 18 months on very advantaged terms. And I would say sourcing and, in fact, creating transactions for counterparties that are complementary, not competitive. So developers are a great source of transactions for us due to their needs to transact for various reasons. Some of the owners that are a little bit more long duration focused are great counterparties for us. And buying assets where there's an opportunity for us to create real alpha that's discernible at the asset level is pivotal. And so really in the edge, the sourcing is incredibly valuable to us. From the standpoint of how do we keep it? We keep it by having an incredible strategy, but more importantly, having incredible people, right? So execution at the asset level is important. Having thoughtfulness around asset management, how that works together with property management, and really working on an ever-evolving business strategy, because the business strategy you have at time zero is not what you wind up with at the end of the investment. And so I think that it's important to kind of create that edge, create that discernible value, and to protect it by continuing to be thoughtful about what you can really be good at, right? And we think that you can be good at, in our experience, very few things. And so we like to focus on those very few things.
So while you guys are focused on a few limited things, when you try to become subject matter experts in them, in order to execute consistently and deliver that level of alpha for your investors, there's going to be a give and take, and it's going to require innovation and evolution to your thought processes to adapt to the times. So Jason, can you just kind of walk us through some examples of how you continue to innovate as investors, and maybe walk us through a recent example of how you've had to evolve your thinking or processes in that spirit of innovation?
I think innovation and evolution are important concepts. Having over 30 years of experience each, we've seen the housing business evolve accordingly. We think that, for example, low ceilings, small windows, subpar amenity packages, gyms and basements are not terribly compelling. We
I
think,
actually like my gym in the basement.
but not when it's at a property. We think that there are certain physical attributes to the real estate complex, to the actual complexion of the real estate, that is very different and have changed. We often joke that it looks like the same architect designed every multifamily from around 1980 to around 2010. And thereafter, all of a sudden, ceilings got higher, light, glass, air got better, amenity packages were more robust. It was more of a communal collaborative experience, and then tenants weren't only living within the four walls of their apartment, but actually living within the complex itself. And those assets that are purpose-built for today's work from home environment, for example, where you've got workstations, where you've got conference rooms, we have indoor and outdoor amenities that are very interesting, a lot of health and wellness offerings, creates a resort-style kind of feeling. So we feel that that was a trend that pre-COVID was happening more due to basically technology. Post-COVID has become a bit more the norm. We don't think it's mutually exclusive where everyone works from home or everyone works from an office, but I do think the ability to work from home, and home being the apartment complex, not necessarily your home, is a big evolution to the space. So I think as far as what we saw was, we said, wow, the product that we were buying traditionally, 80s, 90s, early 2000s garden apartments, had some semblance of functional obsolescence in their future. And the newer product was far more interesting, far more compelling. And while we admire the aesthetic, and we admire the creativity, and we admire the guts that developers take, we're not developers. We think it's a risk reward that's highly imbalanced. And as such, buying newer product from developers that are in trouble, or very young product where the money that we're spending is proactive in nature, it's not reactive in nature, it's offensive in nature, it's not defensive in nature, is a far better living experience. So I would say, we realized that there was a niche out there in more quality housing that we wanted to capitalize on. So that was an evolution. And then lastly, marketing and branding. I think the hotel business has done a wonderful job of sort of managing expectations globally. Irrespective of where you are, when you stay at a certain branded hotel, you kind of know what you're going to get. So why can't we do that too? So 20 years ago, we had our own proprietary brand. It's called The Point. We only manage for our own account. We don't manage for anybody else. We were recently ranked the #1 property management company in the United States by two separate tenant associations, ApartmentRatings.com and Satisfax. So it was nice to get that level of recognition. We think in any business, customer service is important, and so it's something that we're constantly trying to improve at.
That's great. That's great. And, I think being able to identify that trend and action it has been, a great story of innovation, and really has helped widen and sustain the moat that you guys are delivering, or kind of being able to offer. And so kind of beyond those kind of offensive innovations, maybe Jason, if you can kind of just speak to maybe some of the, the challenges, or a major challenge you guys have faced during your history as an organization, and how you overcame it. That could be, recently with the rate environment, it could be COVID, it could be anything else that maybe predated some of the more recent turbulence we've seen in the markets as well.
So as far as challenges in our business, look, we have to be on top of our game every day. We don't have the benefit of 10-year leases or 20-year leases. We have 1-year leases and daily pricing power, and so and a very active tenant base that tells you how you're doing. Effectively the equivalent of Yelp, the way they kind of rate you every day. So we think the management level is really important as far as a focus and an experience. What we found, as I mentioned, kind of adjunct to what I just mentioned, is with the older product that we thought kind of had a little bit of functional obsolescence in its future. It's hard to make an 8-foot ceiling into a 9-foot ceiling, for example. We decided to sell those assets, and we sold all of those assets. We, in fact, cleared out 3 funds worth of assets. All 3 of our funds, funds 1, 2, and 3, were sold. So as such, I think you need to be a good seller when you see that it's an opportune time. I also think you want to hold on to your winners longer. And I would say you also want to sell assets that you don't have the conviction in. Sometimes there is your capital can either be recycled, or it's better repatriated back, But hope is a terrible business plan. You want to basically, have conviction in what you believe. And so if you bought an asset that you don't feel is going to perform as well, Jordan and I have always said, sell your worst assets, keep your best assets, and really, try to drive revenues in those.
Great. So on a similar note, Jordan, this question's for you. So one of my favorite investors of all time, Charlie Munger, is quoted as saying, following the herd invites regression to the mean and average performance. So how do you build conviction to express more contrarian bets in order to avoid mediocrity?
So we've always been very disciplined, and we've always prided ourselves on not following the herd, and to think very much where we want to be selling when others are buying when others are scared. We want to be thoughtful around leaning into strategies when it's not totally clear that that's necessarily the perfect moment, but generally the right moment. And so I think that thematically understanding your business is incredibly important, and having a narrowly defined bucket within which you operate is incredibly important. So, not following the herd, I think that we were, just to touch on what we said earlier, thoughtful around, buying better assets, better locations, newer collateral was not necessarily deemed value add or deemed opportunistic because it wasn't the traditional way of buying an older property, fixing it up and improving it. But in fact, it actually has much greater returns because the revenue opportunities are not limited. The expenses are much more discernible. The non-revenue capital producing needs are not equal at all. And newer assets and better locations typically have a scale and a global marketplace, whereas the alternative does not. And so I think to Jason's point, staying in your lane and staying disciplined is important. So strategy drift is something that we are very cognizant of. So we invest one fund at a time. We don't have competing strategies. So we don't have a credit fund. We don't have those types of structures. And I think that allows us to be thoughtful about investing investing equity in tangible assets and really looking to grow that value beyond perhaps what might be a temporary transaction. And so we like to be active, right? We're not one of the groups that goes pencils down. We're always looking to buy. We're always looking to sell. I think you can be a thoughtful market participant in any market. Sometimes you should be more of a buyer versus a seller, but often you can be a pretty good balance of both. And so we like to be thoughtful around those themes.
To add to that, my favorite Charlie Munger quote is, take the high road, it's far less crowded. But he was a great, he knew a lot about capital markets. I think he knew more about human nature. And, as far as following the herd, I think Jordan and I have always implored, be in early and be out early. I think you want to be a thought leader in that regard. But when the proverbial all clear sign that everyone talks about is there, it's often too late. So you want to hear the herd behind you, but you don't want to overstay your welcome.
So it's, I think the idea of not following the herd is definitely important, but sometimes there's value in knowing where the proverbial herd is going, what they're thinking.
You want them behind you.
So exactly? So what signals from the herd do you emphasize and pay attention to, and which ones do you de-emphasize and not pay attention to?
So, the herd is typically leading toward kind of a broadly accepted way of thinking, right? And so we want to be thoughtful around being ahead of that, right? And so that's why we're thoughtful around, having a healthy acquisition disposition book, being thoughtful around not utilizing too much leverage, but being focused on continually returns, performance, consistency. I think consistency is incredibly important. And I think, unfortunately, when you look at many funds, there's a disparity between performance over time. And so being able to create and utilize that edge and that moat and that discipline does allow you to thematically kind of be continually ahead of the herd, but certainly participating within it.
Great. So moving a little bit to the market today and the landscape, we're kind of alluding to this, but which secular trends that were either introduced or accelerated by the pandemic are here to stay, and which ones are fleeting? And what do you think the implications are for investing in multifamily as a result? So I'll let both of you opine on this one.
Sure.
Sure.
So, the pandemic kicked off a lot of things. Some of the major themes that we saw were, population and employment movement, right? Those are things that we're very concerned about. Those are things that we think about, both positive and negative, right? We want to be where jobs are moving. We want to be where people are moving. And more importantly, where the jobs for the tenants that live in our properties are going, right? So that is a theme that is very much jump-started by the pandemic and continuing subsequent to the pandemic. Hybrid work seems like it's here to stay. We're delighted that people are getting back to the office. It's exciting to be in New York City and to see the streets full, the restaurants full, and the offices full. So that's terrific. It's great to have in-person meetings. It's terrific to be connected, to collaborate, to be thoughtful, not just with your team, but with your various colleagues in the industry. So I think that's important. So for us, that means that people are, demanding and wanting and attracted to living in properties where there are conference rooms and there are breakout areas, and you can live and work within the property in a very productive and a constructive manner. And then another thing that I think that is important is the move out of the center cities. And so we've always had a focus on being in the very close in urban suburban markets, but not in the center cities. So we want to be commutable by car, rail, air. We want to be within kind of about 20 minutes of the major cities. And what we've found is in markets like Northern Virginia, Boston, South Florida, that we're seeing there's incredible employment within those non-center city markets, and that the center city outflow that you saw during the pandemic has not stopped. And we're starting to see those roots take place.
The pandemic was very eye-opening. It was very saddening, and it was a time that none of us have ever experienced. What it certainly reinforced for us was quality property management, quality attention to detail. A lot of our competitors thought that they would be, in our opinion, penny wise and pound foolish. So they fired maintenance techs, they fired leasing agents, they battened down the hatches, so to speak. But what they didn't realize was that tenants were now home 24 hours a day, 7 days a week. So their optic into your operations was really different than a normal work day where they perhaps were home only a few hours a day and not really paying attention. So maintenance staff constantly cleaning, amenities open, run, great signage, great sanitation, great attention to detail, great customer work tickets being answered right away. Was completely eye-opening to a lot of people that sort of had it as sort of happenstance, that's sort of the way it worked, but didn't really appreciate it until they saw it. So we thought a lot of people were short-sighted in that regard. And in fact, look, it showed in collections. If anything, our leasing agents became brand ambassadors, and so they spoke to tenants, and and tenants weren't leaving, so that was helpful too. In fact, our bad debt in our portfolio is negligible, 17 basis points. But during the pandemic, 99.5% of our tenants paid on time and in full, and that's in municipalities where there was forbearance legally, so you didn't have to get the rent. So I do think that we were rewarded for our attention to detail, for our property management, for our care in our tenants. I think that it really showed, and I think people were very happy to be part of their community, to be part of the Point community. And it was something that was really reinforced because the easy decision, the one that was short-sighted, was just to cut payroll, cut everything, don't leave the pool open, don't leave the gym open, don't leave anything open, and give people the bare minimum. We wanted to give people a really robust experience, a special experience, and it was really magnified while they were there, literally observing you every day.
So we started this morning with presentations from Paul and Bob, and some of the major themes that they're both talking about were a lot of the repricing in asset classes and the changing outlooks in terms by asset class as well. Some of the quotes of office being down 37% in terms of asset value, a lot of kind of bullish sentiment around multifamily investing will logically end up with just a continuing reallocation of capital flows from sectors that have been beaten down and where there's just less optimism, like office and historically retail, to areas like industrial and multifamily will probably lead to a lot more competition in the field. So how do you think about investing in multifamily today amidst this backdrop of increased competition with increased capital flows as people shift from office allocations and other out-of-favor sectors?
What I would say is that we're used to investing in a crowded space and in a competitive market. We want to be in those competitive markets because we want the most liquid illiquid we can have. That's why we invest in these only a handful of these gateway cities that have a global audience. And so when I look at the opportunity in the private markets versus the public markets, when you look at the data, the apartment REIT sector trades at about a 5% forward cap rate in today's market, regardless of vintage, footprint, strategy. And yet you see as much as 100 basis points wide of that in certain markets for newer assets, arguably better locations, better opportunities. And so I think that if you have true market beta with the public markets, I think that you have a private to public market disconnect in terms of value. I think you're going to see a huge amount of capital chase that in the private markets. And so I think that the competition is here to stay. I think that creates more and more liquidity within the assets. I think it requires investors to be more thoughtful and creative in how they attract transactions, whether those be single, coupled, or larger format transactions. But I do think that the competition is good for all of us, and I think helps to promote a lot of that strong activity.
Yeah, and I think a lot of our competition, thankfully, have taken themselves off field. A lot tried to get into the credit space. A lot of them chased cap rates into secondary and tertiary markets. Several of them tried to become developers, or went into other asset classes. So, as such, they have a lot of legacy issues, kind of strayed from their core competency. So I think, while there is competition, I'm delighted that we've been fishing the same waters, for so long. So the assets that we get both off market and on market, our reliability in being a closer in our markets, and the efficiencies and economies of scale that we get by operating so many assets that are so physically proximate to one another, does give us a level of credibility in the marketplace. So folks that have sidelined themselves for the last several years and now say they're ready, tell that to a seller and have them believe you.
So that's, as we think about 2025, we just talked on the capital markets and the competition dynamic with the dry powder out there and the interest in multifamily. The other kind of major components, in my opinion, will be kind of where rates are in capital markets there. So we talked a lot about this, but SOFR is now coming down. It's like just over 4.8% or so. The expectation is that it might be going down closer to 3%. Paula might think even maybe a little bit lower based on our commentary earlier. But at the same time, we see rent growth kind of slowing and stalling in a lot of markets, record new supply coming and being delivered to a lot of these markets. We also see a backdrop with lower construction permits and kind of the outlook for the new supply pipeline in 2027 and beyond really being below what we've seen historically over the past 10 years. So with all these different factors in mind across competition, capital market stability, but some uncertainty around the fundamentals, how do you combine all of these things together? And when you think about investing outlook for 2025 and 2026?
Well, we agree with Paul's assessment and your assessment as well that SOFR is coming down. I think rates will be coming down precipitously. I mean, I think one thing that's really interesting within multifamily is that for the blowout in rates that you saw, you didn't see nearly the commensurate amount of movement in cap rates, right? So the resiliency of the asset class, the opportunity within which you have both revenue and expense opportunities is significant. And so I do think when you look at sort of the value opportunity where you have rates coming down and you have in our markets what are cap rates between, call it 4.75% to 5% today, kind of coming in probably another 50 basis points inside of that. If you can buy assets in the mid to 5.5 plus to 6%, you've got sort of an upper teens multiple versus call it, 23, 24 multiple gap. And so I think that that's the opportunity that you want to invest in. And so I think there's more ways to make money than just revenue. I think that the expense line items are incredibly important. I think when you look at NOI growth, it's incredibly important to have the combination of revenue growth should be something that you should be seeking. You should be able to improve. You should have an idea around creating value, creating other lines of income. But more importantly, it is important to focus on the controllable expenses where you can create value, add that NOI growth, and really have a forward trajectory of value.
Look, with rates coming down, we should have some semblance of a yield curve. I mean, we had a 500 plus basis point move in the short end. You have still one-day rates, almost 100 bips wide of 10-year rates. I mean, that's a market anomaly. So I agree, Paula, with the eight cuts. We hope you're correct in that regard. But either way, we see fund flows, and we see fund flows coming in from the debt capital markets first, because look, I mean, Fannie and Freddie each put in $75 billion of capital in multifamilies. That's $150 billion between the two of them. A lot of life companies and banks want to follow their way into multi because, quite frankly, it's a risk-reward dynamic different than commercial real estate. And I think there's a lot of sidelined equity, that really wants to invest. And when they look at the different real estate food groups, multi definitely rises to the top. We often used to say, well, you have no one tenant can hurt you. You have an asset class that should do well in an inflationary market. You have a tremendous dearth of housing out there. Home prices are as unaffordable as they've ever been, and so many people have locked in sub 3% mortgages for 30 years. So quite frankly, that's inflationary in and of itself, because why would you ever sell your house if you had a mortgage locked in that for that long? You did the greatest hedge ever. And the cost to replicate product is extraordinarily expensive. It's not economic now. In our regard, I think that you will find a lot of capital coming in. We're used to the competition, and we're excited that we kind of feel the herd a little bit behind us. We're happy we've been investors for the last several years, where a lot of people have been sidelined. But I do think the debt will help. It's certainly an accelerant, but I think the levered beta players are kind of washed out in this last wave. And I feel that like the folks that create alpha, that have a real niche, that have a real strategy, that have a real management company kind of hand on everything, are able to be able to create more returns than those that are just allocating capital for the sake of diversification. I think that they really should be allocating with a strategy, with a niche, and with an operator that has a specialty in that field.
Great. So I'll ask one final question before I open it up to Q&A. So if you can give one piece of advice, I'll ask for starting with Jordan, then go to Jason. One piece of advice for aspiring entrepreneurs in the room who want to launch their own fund, what would it be?
You have to have conviction in what you do. It takes incredible guts to be an entrepreneur. And so we applaud all entrepreneurs, and we promote it extensively. So I think don't wait too long, get started, and to have a well-defined, doesn't need to be the biggest idea, doesn't need to be so broad in its approach, but having probably more appropriately a pretty narrow box that you're going to create real value within, and creating value around that theme are incredibly important.
I would say don't sell your good deals before you sell the ones that you have less conviction in. I think that I would say that you should find what you're good at and you're passionate about, not because others are going to give you money to invest in it, because it's actually what you think you have an edge on, and do that. And most importantly, surround yourself with a team. Invest in your office, invest in your team, invest in your governance, invest in your infrastructure. Put your money where your mouth is. And it doesn't matter how much you have, but what you have should be in. It should be in, it should be aligned, and you should have as few conflicts as possible, ideally none. And so I think that's my advice for people that are starting out. But don't start out just because you can. Start out because you feel you have the ability to create an edge.
Great. Well, on that note, just want to say thank you very much for joining us for this panel, and thank you for everything that you do for the university.
Thank you.
Thank you.
So with that, I think we'll open it up to some Q&A from the audience.
Cole, question really for you.
Definitely. I've had the pleasure of knowing the Panzers for many years. Previously, we actually worked together as JV partners on some deals back in the day. So that was my first introduction to them, and really got a sense firsthand of how talented they were as investors. And just from the endowment perspective, I think one thing that really makes Jordan and Jason and the whole Pantzer organization stand out should be self-evident in the comments they shared. Having an edge that you can deliver on consistently over time, focusing on alignment, and staying disciplined, and really focusing on that are some attributes that make them really distinguish as investors in the space. Oh, okay.
Jordan and Jason, thanks for this the session, and congrats for building your platform. I think it's super impressive. My question was around team building. I know Jason touched on that a little bit. So when it comes to building your operational team, what kind of attributes do you look for that you think will make for really great asset managers or property managers? And also, what type of KPIs do you set to incentivize them to come through on the performance?
So teamwork's incredibly important for us. Team building is incredibly important to us. So we look for, whether it's property level, asset level, or executive level, we're looking for people who are really terrific in their field and also can share and cultivate a culture and grow a team. And so it's taken a lot of time to get to that point and to create that sort of team base. And so I think having a consistency of message, a clarity of message is very important. We look for performance hurdles that are discernible, they're real, and they get revisited, obviously annually. But we want people who are incredibly incented, not just from a money perspective, but actually from an accomplishment perspective. Right? This is the most valuable component of what we have and what we do is our team. That's the thought process. That's the edge. And that's why we don't partner with others, because we don't want to sell that off for a fee. And so, we like longevity. We have a lot of team members who've been with us for a long time, and who are thought leaders, and who look to kind of bring up and grow a team.
My question is about the size of assets. I'm an architect who does multifamily buildings. Over 20 years, we've seen the optimal size of a new project go from 200 units to 350 units, mainly because of software, improvements in software, improvements in identifying troubled tenants before they get in your project. And so the question I have for you is, how you optimize management teams when you buy new older projects that aren't necessarily optimized for what the teams can manage these days, if that makes sense. So how do you adjust teams to the typical project? Like if you get a 400 unit project or a 180 unit project, do you self-select projects, or do you actually adjust management teams to the project size?
Maybe it's helpful to kind of explain a little bit the cluster.
Yeah, so our properties are, we only invest in one asset class, multifamily, and we only invest on the East Coast. And within the East Coast, we only invest in Boston, Philadelphia, Northern Virginia, and South Florida, in the Palm Beach, Miami area. So in markets, we have, let's say, 10 or 12 properties in a market. So for example, due diligence. When we buy a property, most people's definition of due diligence is you call the seller, they free up 5 to 10 units that they choose, and you walk through them for an hour, and then you have lunch. That's very cursory due diligence, okay? We walk through every single unit. We look at every single lease, maintenance tech to maintenance tech, leasing agent to leasing agent, property manager to property manager. That dialogue is really important to kind of get a deep dive into the asset. Almost never has a maintenance tech, a leasing agent, or a property manager been asked, what do you think? So if you ask that question and let them talk, they will often tell you what's going on at the property. And very often, they're interviewing with us effectively for a job, and we may hire them. So we're constantly trying to get better quality talent as we buy assets. When we sell assets, we try to incubate talent as well, because we'll continue to buy in those markets. We love the stories when you visit our properties. There's someone that was an assistant property manager that became a property manager that became a regional manager. So promoting from within, cross, training where people go from one property to the other are really important. So building that team dynamic is very special. And funny enough, you buy a property, for example, for $100 million. The property manager at that asset, working it every day, is running a $100 million business. You have to think about it in that regard. So we want great quality people. We want to compensate them well. We want to show career trajectory for them, which is important. And as far as your comment on correct amount of unit sizes, I think 200's around the bare minimum. I think kind of 200 to 400 is a good range. You want to have on-site staff that shows that customer experience, because I mentioned it's sort of a little resort-like now, where people are there more often. The amenities are just bigger. The complex is not, has kind of that communal concept to it. So I do think that's a sweet spot, kind of 200 to 400 units for us.
Thank you.
Following on the entrepreneurship, on that question earlier, can you speak to the transition from Wall Street to the syndication/fundraising space, and what the best advice is for kind of that budding fund manager or somebody that wants to move into that space?
Well, so we were pretty deliberate collectively in really getting financial advisory, lending, and private equity experience before we got together and really then started investing in what were modest-sized deals using friends and family type money, and then evolving into the institutional side of the business. So I think it's important. It was important for us to have that lens, right? So to make significant connections, to have a sense of kind of where we would be effective, right? What certain counterparties are thinking, how they do what they do, and what we could put forth with our own business. And so when we started our syndication business and then evolved it into the institutional business, we took a lot of what we liked and didn't like from our prior experience. And so we think it's important to be aligned. We think it's important to be incredibly ethical. We think it's important to be thoughtful. And what we found over time was that what was at one point minimized, which was property and asset management business, niche specialties, and actually being an operator, became incredibly valuable. And so rather than it being a negative, we turned it into a significant positive. So we're happy to have seen that growth. We're happy to have stayed within that focus. It's been an important part of our evolution and continues to be as we grow.
Okay, well, thank you very much, Joe.
Thanks.